Thanks for joining us for part two of our macro roundtable with several of the top minds in online finance today. If you haven't yet watched part one of this roundtable discussion, where Danielle DiMartino Booth, Lyn Alden, Stephanie Pomboy, and Ivy Zelman debate the biggest concerns about the precarious status of today's economy, social stability, and financial markets, head over to our channel at youtube.com/Wealthion and watch it there first. It's really one of the best discussions we've had yet on the Wealthion channel. And it also sets the context for the investment perspective that these experts, as well as our partners at New Harbor Financial, share in this video. Before we begin though, please take just a moment to support this channel by first liking this video and then clicking the red subscribe button below, as well as that little bell icon right next to it. Those simple steps really are a big help to us if everyone watching this video takes them together. Okay, let's get started watching part two of our macro roundtable. Are we kind of at a Wile E. Coyote moment for the average household, where we've had this kind of relative tranquility of the past 20 years? Yeah, it was punctuated by the global financial crisis, but beyond that, it's kind of been this relatively tranquil era of prosperity in America and in many other developed nations. And I think we might argue that one of the reasons for that is because we were pulling a lot of tomorrow's prosperity into today. But are we at that inflection point where, you know, the chickens start coming home to roost, the piper has to be paid, whatever analogy we want to come up with here, but may we be staring at a decade of substantially lower, kind of quality of living for the average American household? Danielle, I'll start with you.
So, Adam, I think that the risk is definitely there. I wish it was not the case. Part of the driver here is the political division that is as acute as it is now, because the inequality divide has been widened to the extent that it has, as both political parties in the country side with corporate America, big corporations, big box retailers, the sacrificing of the small business sector in the post-pandemic era. There's a lot of bitterness about in that respect. Lower middle income, they've been pushed into lower income. That's being exacerbated by housing expenses and prices at the pump and prices at the grocery store being as high as they are. If you're right above that rung of Americans who qualify for all of the social safety net programs, but yet you don't, you're not happy right now. You're not. And there is something to be said for having to be cognizant of how far you can push the inequality divide without something societal coming back to haunt you. And that's what keeps me up at night. That's what really bothers me. It's that there's this undercurrent of unrest and dissatisfaction, and you get the sense, whether you're talking about Palm Beach, or the excesses are in your face of the wealthy and the way they live their lives. So it does concern me. And I can't suggest you what the solution might be at this juncture. Again, I think the Fed is going to be forced to not come to the rescue of the economy for the first time in more than 40 years. So that's going to be a game changer to the extent that they've backed themselves into this corner by monetizing all this stimulus. Now they've got inflation on top of a slowing economy, but I don't think that they necessarily have the tools. We forget that it took fiscal and monetary stimulus combined to react to the pandemic. And that fiscal aspect is simply not going to be there if we're 6 months outside of a midterm election that promises to be even more contentious and add fuel to the fire of what I've just described.
Monetary policy didn't get us into this mess by itself. It was fiscal and monetary policy.
Agreed.
And the fact that fiscal policy, to your point, can't do anything with midterms coming. I think that everybody's focus is on the Fed. But, the amount of stimulus, is raining money, and it unfortunately didn't go in the neediest hands, with respect to the liquidity. But one question for you, Danielle, thinking about social unrest and the risk of a tipping point, I think that is there some mechanism that there'd be support on both sides of the aisle if they were to see something catastrophic coming to fruition? I mean, it would seem like just like an emergency type of another Band-Aid, another way to try to step in the fiscal arena.
So I think if we were to see a wholesale freezing in corporate bond issuance that trickled its way into immediate pink slips and much more downside than what we're seeing in stocks, even to a greater extent, I think if you were to start to see some kind of a feedback loop mechanism come into motion, that could compel both parties, because it has in the past. Emergency situations do indeed trigger these things, but again, bear in mind, this is, I fear these midterms are going to make the 2020 presidential election look like a walk in the park.
And I'd love to dive into that, but I fear we don't have enough time to really tug at those threads. Real quick though, for you, Danielle, when we talk about something breaking, right? Powell hiking until something breaking, is your expectation that when something breaks, he'll reverse to a dovish policy stance again?
No central banker in the world is going to allow systemic risk to become unleashed and not do anything about it. You don't watch the global financial system implode. And the corporate bond market and this black box that's mentioned of the Chinese debt market, and the fact that Europe looks like it's going into recession twice in a row before being able to ever bring interest rates technically out of the negative. There are too many interlocking pieces right now, and two great big nations who are hoping that something breaks in the US economy so that they can take a geopolitical moment and make that into geopolitical history. So in that sense, Powell cannot let systemic risk come unleashed, because then you're talking about the sanctity of reserve currency status. It's a bigger question, Adam.
Okay, all right. Lyn, going back to you on sort of this larger, your assessment of the social vulnerability that I just sort of ran through that laundry list earlier. Are we potentially looking at maybe like a lost decade ahead of us for the average American household, or do you have a more sanguine outlook than that?
I think at least for asset prices, that's a really key risk. And so inflation was always the limiter, right? We've had a 40-year period of structural disinflation, lower rates, pushing up asset prices. Every sort of disinflation or deflationary event, the Fed could come in and liquefy markets. Fiscal stimulus could come in and liquefy, the consumer, especially in 2020. And with inflation as high as it is, those tools start to have visible costs to them. And so I think that's the thing going forward. And going back to the point about, to what extent the stock market versus the credit markets versus recession kind of, impacts Fed policy. I think one way I look at it is that the stock market going down is by no means a trivial matter, especially for an economy with a twin deficit that's so reliant on consumer spending. It's that I think that, Jerome Powell can't get up in front of Congress and say stock prices down, so we have to, be more dovish. It's that the stock market going down eventually leads into credit markets going down, eventually, causes that cascade where then something breaks and Powell has to come in and be like, due to, recession indicators, we have to, be more dovish. And so I do think that, kind of my risk outlook for the 2020s, not just the year ahead, but just in general, is those more stagflationary types of environments, monetary policy alone not being enough, and contention within fiscal policy about how to best deal with it. I think that there are some bipartisan issues they can explore, like, for example, payroll tax cuts, for example. You would think that that'd be somewhat bipartisan because Democrats could use it to, support labor, and Republicans can use it to support tax cuts. But you don't really see that type of kind of common sense policy. Instead, you have kind of the pork and the debates they have in other areas. So I think that they have tools available to them if kind of cooler heads prevail. But given just fiscal deficits where they are, inflation where it is, debt levels where they are, I do think overall that this is more of a decade of payment rather than those tailwinds continuing. Okay, great. So it does sound like you think tougher sledding ahead for the average household going forward. Ivy, I want to give you a chance just to comment on housing here, kind of in this theme, because again, we had sort of talked about is the growing inequity in the housing market potentially going to lead to some social ill here, or some serious social ill here. So I'll let you comment on that, and then Stephanie, I'll come to you, and we'll sort of wrap up with the big question I know that's on most viewers' minds here is, given everything we've talked about on the macro side, what does an investor do? And I'd like to translate that question into sort of what assets do you think are, likely to do better than others, given the type of macro environment you foresee over the coming, let's say, 2 years. But Ivy, I would like to give you a chance to just comment any way, shape, or form in the housing market there on the social end.
Yeah, I think with, 65% home ownership rates right now, those people that are in a home have seen significant wealth creation, that they now, we're seeing the benefits reflected in a significant cash out refi to help fund spending. But it's that 35% that are renters that are, really going to be feeling the pain, because rent inflation is 3 times normal, if not more, in certain cities relative to trend line. And I think it's very disheartening for today, the tenants that are getting notices of renewals that are in the high single to low double digits, that they're going to be forced to likely find alternative shelter, again, household consolidation. And I think that that's really not something that people are contemplating. So I think it's really a very challenging environment, and only exacerbates the divide in terms of the inequality for those that are fortunate to be homeowners and benefiting from the inflation, to those that have a variable cost that they're going to have to, contend with much higher of their overall income going towards shelter. So I think it's going to be very problematic, and could, to Danielle's point, lead to more social unrest, because don't think that the stimulus factors that we talk about, with all the amount of cash that people receive, in whatever form, child care tax credits, et cetera, but they were also, people didn't have to pay student loans, people weren't evicted, and
All the
people were not
forbearance.
foreclosed, and they weren't foreclosed. So that clouded sort of what the true underlying strength of the consumer is. And don't forget, there was a period where many people were in their homes, hunkered down, worried about dying from COVID. They weren't spending anything. So we had sort of forced savings in some respect. And so I think that as we unwind, I think to Stephanie's point, you're going to see a lot weaker underlying attributes that the consumer will start to visibly show, and yet their income is not rising as fast as overall costs, and shelter being one of the biggest ones. So long-winded answer, but definitely problematic if the landlords continue to step on the gas, and they're stepping on the gas because they believe that everything is so tight that enables them to just continue to push forward, when it really isn't what appears to be the case. The consumer is not as healthy as I think that people perceive them to be.
Yeah, I mean, that's just the recipe. That list you just went through is the recipe for social unrest. And I have no clue here, about the breaking point and what the ultimate trigger might be if we do indeed reach one. But you guys have all made a great case that don't discount a social breaking point being a contender in here versus just an economic or a financial one.
What about in LA? Think about the looting and the stealing along, the rails with all those Amazon packages. And, we all look at that and like, oh no, thank God it's not in my backyard. But there's no question that, whether it's the crime rates are going to rise. I mean, we're seeing it in various pockets, and that could really materially get worse if people get hungry and they don't have shelter. So it's concerning.
All right. All right. Well, Stephanie, coming to you, feel free to add anything to that. But if we can, in your answer, sort of get your thoughts on, all right, if you're an investor watching this who's concerned about the major trends and macro risks that you guys have elaborated on here, where are potential, assets, sectors, et cetera, that you might encourage them to consider looking at?
Okay. Well, to segue from the macro discussion to those investment ideas, I guess I would just argue that I do think you would see fiscal stimulus if the wheels came off the markets. I think they would come together with some bipartisan plan. I think Lyn, laid out a couple of suggestions that would probably get bipartisan support. It inures to no politician's benefit to have the economy lapse into recession because of a meltdown in the corporate credit market or the stock market, which would necessarily happen if those things unfolded. So that being said, I think the question then becomes, from my view, how big a fiscal stimulus are we talking about will be required to be coupled with monetization by the Fed. In other words, lather, rinse, repeat. We're going to do over everything they've done every time they've inflated a bubble and then inadvertently burst it and then had to clean up the mess after. I think the question this time is just how long it takes them to figure out they're making the same mistake and how big the response is going to have to be. So if you believe that as the framework, then it would lead you to safe havens like gold, for example, because you would see substantial further debasement in the dollar And it would obviously not just be the dollar. This would be a global currency debasement, competitive currency devaluations like we see every time. So hard assets, and I would defer to Ivy about whether we have an air pocket in housing and then we rebound because people are going to want hard assets, and housing is obviously one of those, the largest one. But then getting into sort of specifics in the market, I would be serially avoiding consumer discretionary stocks. I think that's an area, as I mentioned at the top, where expectations are just so far ahead of the likely reality. The other one, if you believe the scenario I laid out, would be financials. I mean, there's a lot of bullishness about the financials based on what everyone anticipates will be a steepening of the yield curve, notwithstanding the fact that the yield curve has relentlessly flattened throughout this entire taper and the pricing in of multiple rate hikes this year. So I think that's sending you a message that people who are clamoring into the financials are clearly ignoring. And that's before you layer in the prospect of a deterioration in credit quality, which if my forecast for a substantial slowdown or even a recession in the US comes to pass is obviously going to happen as well. So, in terms of places that you can protect yourself, as I mentioned, gold, real estate, although I defer to Ivy on how to invest in that if she thinks that that's a place to be ultimately. And then I'd probably be overweighting emerging markets and resource, particularly oil producers, because I don't think oil prices are going down anytime soon, even though you'll have demand destruction in terms of slowdown in global growth. I think given what we're seeing with, environmental policies in the West, oil prices are going to continue to remain very high. So I'm kind of tempted, if I can throw out a really harebrained idea, to eventually get long Russia, because that's going to be the most levered way to play an upturn in oil. But it's, that's something you do with money that you could light a match to. So.
Great, Stephanie. And you just underscored that we didn't even talk about Ukraine and that kind of geopolitical risk in this discussion yet, or today. We'll have to save it for a different roundtable. Danielle, I saw you doing a lot of nodding as Stephanie was talking there, so I'll go to you next. What else, if anything, would you add to her list?
Well, I think staples are going to be a safer haven just because there are going to be essentials that are going to have to be covered by the household budget to the extent that they can. I mean, and that is, it's a fact of life. So I would look for strong balance sheets inside the staples space. I certainly haven't let go of any of my gold. And I would again, I'm reiterating what Stephanie said. I would also add, however, that, if worst case scenario comes to pass, I look for any and all, what I'm about to say, Adam, I look for any and all opportunities to buy into cheap municipals when the entire space gets shellacked, because there are a lot of states and municipalities out there that have been very fiscally prudent throughout, and it's going to be the baby with the bathwater being thrown out. So I always look to opportunities for kind of look up towards the center of the country, but to the left of Illinois. And there are some great opportunities out there that I would be looking to in that space as well.
Okay, good. I was going to ask you if you were still
Yes.
in favor of munis, and it sounds like you are, in the right
But not
location.
the ones that are going to blow up, but yes.
Right. And maybe almost it sounds like be poised,
Caveat.
maybe with some cash to jump in if they all go down for a bit.
Absolutely.
All right, Ivy, I'm going to come to you about real estate. I'll let you close on that though. So Lyn, let's go to you next.
So I've been fairly bullish on healthcare and consumer staples and some of these kind of non-cyclical value areas. In addition to energy producers, I like the energy transporters, the higher quality ones with decent credit scores and good handle on their debt. Because I don't think we're gonna, U.S. energy policy, given high oil prices, I think some of the pressure on some of the producers is maybe waning to some extent, and supply, it looks pretty good for some of those pipeline companies. I do echo gold as a pretty good environment, especially as as the economy continues to decelerate, as you see PMIs roll over, as you see leading indicators roll over, gold looks pretty well positioned in this environment. And then emerging markets are one of my kind of risk on areas. I've been liking Brazil. I've been liking some of these other markets for the kind of the riskier side of my portfolio. And I think as you eventually trow and then turn up, you can look at things that were drastically oversold. So I do think that Russia could be attractive. I think some of the oversold growth stocks could be attractive. In the next rising PMI environment, I'd be bullish on Bitcoin again. So I think there are, a bunch of different kind of layers depending on how far you want to look out on this. But I think the era of broad U.S. large caps going up is somewhat more challenged going forward than it has been over the past 10 years, and then more broadly over the past 40 years.
Okay. Real quick before I get to you, Ivy, on real estate, just toss a question out to anybody who wants to answer it. I guess two questions. One is, how concerned are you about a substantial market correction in the relatively near future? And by relatively near future, I'll say the next 12 months, right? It could happen at some point in 22 or early in 2023. And along with that, how do you feel about cash right now as a position in a portfolio? And I'll let anybody chime in on that if they want.
I'll hop in real quick just to continue. So I think, as long as we're in this declining PMI, declining, leading indicator environment, I think we are at risk of ongoing correction. I don't think it's very favorable for asset prices. I'm not maybe as bearish as some of the outright bears out there, because you're measuring it in a currency that I think is going to devalue significantly over this decade. But you can certainly have these air pockets where you go down 20%, 30%, maybe more. So for that reason, even though I've often joked that cash is like the most speculative asset that I own, because it's something that I hold knowing that it's going to lose value, but that I hold it anyway because I'm kind of speculating that some of my other assets that I actually want to own might lose value more in kind of a near term, kind of 6 to 12 month period. So I do use cash as a volatility reducer, a rebalancing tool in this environment. So I think that you go forward, you have 7% inflation, you have roughly zero yields. Some types of assets have a little higher yields. You're getting devalued. But if you have stocks go down, notably, then cash ends up outperforming for a period of time. So I'm not particularly bearish on cash with a 6 to 12 month view.
All right, great. Ivy, let's now come to you for real estate. Sort of general outlook as you think. I think we're looking sort of with the investor mindset here versus sort of the homeowner mindset. And I think one of Stephanie's questions was, there's a lot of reasons to want to own real estate in the type of environment that we're talking about. But if we get into some, rocky periods with the financial markets, could there be an air pocket under there, in the near term? So what do you think?
Well, and thinking about sort of 6 to 12 months while we're seeing the supply really drip to the market, I think that investors will find real estate to be a better hedge than, let's say, equities or alternative assets that we've certainly seen risk on that's now becoming risk off. But the risk would be that if you're in a period where the supply is rising, you will see prices correct. So I think that you can almost draw within the map of the US, there'll be places that are safer, like the blue states, where you just don't have as much supply coming and where you have inventory that will remain extremely tight. I think that if you can get your hands on some real estate, it could be one of the best relative returns. But I think the areas where the pipeline is really big, I think there's a lot of risk that those markets, especially the concentration is not only within, let's say, the Southwest, the Texas and Arizona and, Idaho mountain states, but you also have concentration risk within where they're building, like in the tertiary markets. So I wouldn't want to be an investor doing a strategy to go after new supply in the third ring of any market. I would be looking more selectively within the areas where the institutional capital is not very prevalent. So you could still have a relative, to your point, with Lyn's point about relative return, cash may not be attractive, or you're losing value in cash because it's, you're at 0 and 7% inflation, but on a relative basis, some of the real estate might be safer and you may not make a return, but you might hold your capital and you do have a cash flowing asset, assuming you can find tenants in a tight market. So real estate near term in the right locations could be an attractive asset to be investing in. It's just a question of being careful not to get where the capital has been so targeted right now.
Okay, great. Well, I've got one last question to ask all of you. Before I do, I'll just toss it out there. I know several of you are meeting each other for the first time live here on the Zoom. If there's a question that you would love to ask someone else on this panel that I haven't thought to ask yet, you're more than welcome to do that now.
Stephanie, how's Miami?
Close. I'm in West Palm.
West Palm, okay.
I'm a spectator to the lavishes and the riches that you alluded to in Palm Beach. It's good. You have to come visit sometime.
My best friend is there. I'll be there soon.
Okay, well, you have to let me know.
Yes, indeed.
It's been too long, so.
But Stephanie, the reason I asked that question, Adam, is not to be cheeky, but it's because Stephanie's emblematic of this migration that we've seen
Yeah.
in a post-COVID world that, you know, I worry about the states that have these massive pensions and the laws that have pushed people out, because I can't imagine that wave does not continue as a factor of time if we go into recession.
Well, and wait till they raise taxes. You know, New York.
Well, yes.
You know, I left New York because it was expensive when I left, but it's only going to get more expensive. And it's not like the quality of life there was improving. So,
well, as someone living in California, we're seeing the exodus happen every day here. So
even though you're seeing the exodus, the housing market is as strong in California as it is in many other parts of the country, which is really kind of mind-boggling how that could be the case. You know, if everyone's leaving California, and New York is really strong too. You can't find a house in any part of the, 5 boroughs and tri-state area. So that's where the, confusion lies, is if everybody's leaving those states, then why are they so strong?
yeah, and if you're a prospective first-time home buyer in these states, you're just tearing your hair out right now.
Yeah.
So Adam, can I add one thing?
Absolutely.
For all of your viewers, I would, if you don't understand what the standing repo facility is, please study up on it, because it is the one thing that is going to give the Fed more ammunition than you think the Fed has. So I would do your homework there.
I agree.
All right. I am going to, next time I interview Danielle, we'll go deep into that to let you help people really fully understand that. But in the short term, yes, everybody go Google the
Standing repo facility, that one.
Sorry, standing repo facility. Sorry. All right. Well, look, in wrapping up here, if people have enjoyed this roundtable, and I'm going to go out on a limb here and think pretty much everybody watching has thought this was fantastic. If people would like to learn more about each of you and their work, where should they go? Lyn, let's start with you.
I'm at lynalden.com and at Twitter at Lyn Alden Contact.
Okay, great. And as you guys mentioned these, I'll put the URLs up on the screen during the editing process. Ivy, how about you?
Ivy at zelmanassociates.com.
Great. Stephanie?
You can find me at Pomboy on Twitter, or at Macromavens, www.macromavens.com.
All right. And Danielle, I think you're known to send out a tweet or two, right?
I tweet from time to time. I've been known to do it at all hours, in fact. And other than that, www.quillintelligence.com. Of course, I'm
great. And sorry, what is your Twitter handle there too?
It's at DiMartino Booth, and actually, I have a private Twitter handle for our QI Pro clients. It's becoming quite interesting, but private. So.
All right. If folks want to learn out how to get on that list, where should they go? Should they go to your website or?
Come to quillintelligence.com. I'll tell you how to get in the private feed.
All right. Well, ladies, thank you so much for doing this. This has been wonderful just as a spectator here, but just I had huge expectations for this and you guys exceeded it. I hope we can have you back on to do this again at some point in the future. Everybody watching, definitely go check out all these ladies' websites. If you would like to see them come back on the program to do another roundtable format like this was our pilot one. Let us know your thoughts in the comments section below. Other than that, please help support this video, getting out to see as many people as possible by hitting the like button and then clicking on the subscribe button below, as well as that little bell icon right next to it. Ladies, thank you so much. I cannot wait to do this again with you in the future. All right, now's the time on the program where we speak to Wealthion's endorsed financial advisors to get their feedback on what our roundtable talked about, but also more importantly, to talk about what the markets have done in the past week. And boy, have they done a lot. I'm joined as usual by the lead partners at New Harbor Financial, Mike Preston and John Lodra. Hey guys, thanks for joining. John, why don't we start with you? What did you think about this panel, which honestly I think was really one of the best discussions we've yet had on this Wealthion channel? And before you answer, I should flag for folks that the discussion was recorded less than 48 hours before the Russian military action in the Ukraine. We're now recording this the day after the night that it all happened. So we've got a little bit more context than the ladies had there. So John, what did you think?
Yeah, Adam, wonderful panel. You assembled a really great collection of voices and minds and insights. We've had the privilege of being, kind of guest commentators with each one of those guests in separate interviews with you, and to have them all together at once is a real treat. Always learn a lot from those great minds. And to your point, that there have been some very significant developments since you've recorded that, most notably the Russian invasion of Ukraine. But so far as the commentary and the comments that your panel made, I think they're timeless in the sense of where we are currently in the market cycle, irrespective of what did or didn't happen, as concerning as the events that transpired overnight into today have been. And the big picture, I think, woven through all their comments is that we are in a very distorted marketplace, everything from valuations to credit spreads. Of course, the common thread there that I think each of and in real estate, I would be remiss if I didn't talk about real estate, because that was talked about in pretty good detail. But a common thread there was the influence of the Fed and central banks, and the role there over the last bunch of years to create the distortions that we're now having to kind of navigate and contend with. And I think to every last one, even though there was subtleties in the differences of exactly how things play out, was that the market's probably being too complacent in terms of what the Fed and central banks are likely going to have to do to address things like inflation. And the takeaway there is that they likely will not be as much a friend to financial markets as they have been in recent years, because the need to stamp out other problems like inflation is far greater, politically and otherwise, and that their tolerance to let things drop or weaken is far greater likely now until something truly breaks. And it was talked about, for example, the credit market. If the credit market truly and seriously kind of seized up, that would be perhaps the turning point where some of the tightening policies that have been talked about would have to be truly shelved. It is notable that 3 Fed governors in recent days have reaffirmed kind of the hawkish talk, even as recently as today, even with the Ukraine crisis unfolding. It has been mentioned that that will maybe need to be taken into account in the policy actions. But that's kind of the big picture takeaway that I think I and hopefully your listeners took away from the conversation.
All right, great. And I do want to get to the specific action that transpired today, because it was truly pretty historic and also like counter to probably everybody's expectations when the day started. But Mike, let's go to you for anything else you want to add to what John said. And I just want to react to one thing you said quickly, though, John, which was you talked about how each of the speakers essentially said they expect the Fed to tighten until something breaks. I didn't hear any of them say, I expect the Fed to tighten until inflation is tamed and the situation is brought under control. They all basically expect that we're going to reach some sort of fairly substantial systemic breaking point in the sort of next chapter going forward from here. So I really took that as a lot of pessimism from each of those 4 experts. So Mike, going to you. Anything to add to what John said there?
I think John summarized it really well, but just a couple quick thoughts. Each one of the speakers seemed to believe that the economy was weakening. Lyn Alden said, it's likely that we have a stagflationary outcome. We agree. You've got high prices and a weakening economy. It's not a good situation for consumers. It's at the same time, you shouldn't expect the Fed to be accommodative and to bail the markets out or the economy out. The Fed has to rein in inflation. There's high political pressure to do it. I think it was Steph that said the economy will likely surprise to the downside. That's almost certainly true. And Danielle said something like, Powell may actually allow a recession. I mean, can you believe it? The Powell put. We all think the Fed won't even let the smallest wiggle happen in the market. And I would not be too complacent with a market that's still down only about, on the S&P, about 11%, just over 10%, hardly even in correction territory, at valuations that are higher by far than we've ever seen before in our lifetimes. So a dangerous place, particularly if you rely too much on the Federal Reserve, who almost certainly has a mandate now to rein in inflation. And I think we're going to see some surprises.
Okay, and you can kind of interpret their commentary there as sort of like, hey, it's different this year, right? That this is going to be the year that the Fed is not going to be able to, the Fed or China or whoever sort of bailed out the system in the past is going to step in and do the same, and that inflation has introduced a whole series of constraints that make a lot of things that were possible beforehand not anymore. And I think that's largely true. That said, it doesn't mean that sort of business as usual in the markets isn't over yet. And John, I just want to now focus a little bit on today's action. So we're recording this after close of the market on Thursday. Overnight, Russia basically engaged in what it called special military operations. Other people might call it something more aggressive than that. But it really was sort of a shock and awe campaign to take out a lot of the Ukraine's key military and communications infrastructure. And as you might expect, the markets really didn't like that in the overnight markets. Most of the major indices were down around 3% or so. Gold went bananas. It just peaked above $1,900 an ounce. It got as high as like $1,970 an ounce I saw in the futures market. Silver was screaming higher. Oil was screaming higher. I think oil was up like 7 or 8%, in the late evening. We then opened, and markets opened down pretty substantially. But then, they started clawing their way back, and everything closed green. The S&P was green, I think a little bit over 1%. The NASDAQ closed up like 3.3%. Just things you wouldn't think would happen if the world was truly concerned about a major military operation that could, ramp up the threat of multinational warfare. So it still remains to be seen, still a very fluid situation. I'm predicting there's going to be a lot of volatility going forward. But by the end of the day, all the major indices were green, led by the usual characters of big tech companies. And gold and silver came down off their highs. They all closed in the red. Oil came down an awful lot. Again, I think if you had placed, I think most people's expectations at the beginning of this day were completely shattered by midday, and then, just totally decimated by the end of the day. Love to get your commentary on this, especially as somebody who's sort of trying to manage capital through all this.
Yeah, crazy is the only way to put it, Adam. I guess fitting for the enormity of the events that took place overnight. Even though it wasn't news, so to speak. We're no geopolitical experts, but citizens of the world. This is a big deal, right? It really is. And I think the geopolitical events and ramifications will tremor for a long time and probably get worse before they get better. But again, it's funny how, not funny, but markets tend to blindly behave in a cliche-like manner, I guess is what we observe. And there's a time-honored cliche to, sell the rumor and buy the news, and there's various, variants on that. But, in other words, sell on the rumors of war, buy on when the bullets start flying, right? And that's kind of what happened here. I mean, the moves were, the most immediate thing that I can recall as to markets across the board doing a complete flip like this in the span of pre-market and close of the next day was right after Trump won the election. Stocks tanked, gold shot up a gazillion dollars, and by morning and by the next day, it had all reversed in an equally large way. that's really kind of what this market tape behavior today reminded me of. And geez, it's certainly not. There was some. Obviously there was a presser today by President Biden. I didn't get to watch it, but I certainly saw some of the news clips, and I think the general consensus is that the heavy-handed, hardline sanctions that were promised were kind of all bluster and not much teeth and bite. Russia has not been evicted from the SWIFT system, which would be a really material economic, bite to them. So I think the market maybe said, you know what, well, there's no teeth here, so maybe it's not going to be as much of a showdown as we would have expected, perhaps. I don't know what to make it, frankly. It's a geopolitical theater that we, but the market reaction is just absolutely eye-popping. Stocks did a complete reversal. Oil was up. It went from 88 yesterday, I think, to 100 at the high overnight a barrel, closed at like $93 a barrel. Gold and gold miners did a complete flip-flop. Gold miners were up, 4%, I think, at one point in the pre-market, and they closed down a couple percent. Yeah, it's just there's no logic. I mean, it's a bizarre theater for a really, crazy day is the only way I can put it.
All right, a bizarre theater. I think it's a good way to put it. And Mike, and John, I want to talk to you guys both about the miners in just a moment, because I think their activity was a real head scratcher, I think, for most people. But very quickly, I do want to just sort of flag in more volatile markets like we have right now, and obviously the situation in Ukraine just really shook up the entire box of volatility. But in a volatile market, you do have more opportunities to make money. And I'm talking more for sort of the really active investor here, not so much the long-term buy and hold investor. But of course, we've been talking that the days of passive investing are largely going to be, less applicable going forward, and you're going to need a more active approach. And today was a really good example. So leading up to today, pretty much the S&P had done nothing but go down. The major indices had done nothing but go down since the beginning of January. Very few up days there. We got into correction territory, as Mike said earlier, S&P down over 11%. And it probably was due for a relief rally prior to this night's activities. Then, of course, everything got just exploded by Russia's incursion there. But today, obviously, we hit some sort of important floor, and markets are now having a bit of a face ripper rally, and it's going to be interesting to see how long that carries through. So folks that were sort of positioning for that reversal in the markets, well, if they were positioned yesterday, they probably did pretty well, actually. Today, given the huge downdraft in the markets, you had assets you could buy this morning that were worth an awful lot more by the end of the day. And in particular, a number of Russian companies got hit extremely hard. And guys, I'm sure that's no surprise to anybody, right? But you've had some really high quality Russian companies go on sale today by 30, 45, at times 50%. I'm thinking of a couple of miners that Rick Rule mentioned when he was on this program last, that he thinks have the best gold deposits in the world, as well as very large Russian energy companies. I don't want to mention the names here just because I don't want to be perceived as giving personal financial advice, which is what I'm definitely not doing here. But you had the ability to buy some of those large energy companies, in the morning, that were worth like 30% more by the end of the day. And these are companies with ridiculously low PEs. I'm talking like 4, and having dividend payment rates somewhere in the 6 to 10% area. Now, of course, they've got huge country risk, and Russia just proved overnight that country risk, geopolitical risk, is still very relevant in today's world. And who knows what's going to happen going forward. But if this military incursion turns out to be relatively short-lived, if the dust settles over the next couple of months, and the multinational community begins to learn how to work together, and whatever new world order exists after the dust settles, this may be a historic moment to be entering into some of these, very excellent in terms of resources companies, like total world grade resource companies. So, Mike, I'd love to get your thoughts on that.
Yeah, some of the moves were crazy. You're just taking a look at Russia, for instance, just take a look at the ETF RSX. I mean, it's back to the COVID lows, and it's back at multi-year lows. And so you mentioned some of the energy names in there. Yeah, they're really, really cheap. Now, it's a big if. You say if it turns out to be a short-lived affair, maybe some of these are good bottom fish plays. Maybe, yeah, we would proceed fairly carefully, but emerging markets might be a better play. Emerging markets got hit pretty bad across the board, which I think Russia is actually part of. It's the emerging market index is more emerging Asia and South and Latin America than it is Russia, et cetera. But emerging markets were down sharply this morning. If you look at EEM, which is an ETF that tracks emerging markets, it was down around 45 or something at the low after being relatively weak the last few weeks. So emerging markets remain cheap, and we think that they remain attractive and probably would be somewhere that we would direct the more conservative investor to just buy the entire, maybe emerging market space versus trying to pick individual names. That being said, yeah, there was some fantastic bargains that reversed by about 30%. I just want to say a couple things about this eye-popping reversal, though. It was a big reversal. It was the biggest reversal since I believe the Paycheck Protection Program was announced back in 2020. But just stepping back for a minute, just looking at some of my notes, the S&P was down 14% at the worst of it today and closed down 11%. Yes, that's a 3% reversal, but the S&P is only down 11%. Valuations are still very high, and we still haven't even had, in our opinion, the first leg down. If this is a bear market that's starting, we really haven't even had the first major, I don't think, panic day yet. We had a little whiff of it at the open or in the pre-market, but boy, this market basically bottomed at 9:30 a.m. and just went up all day. We haven't had a 90% down day since the top a few months ago. A 90% day is a day in which 90% of the stocks decline. It's a sign of capitulation or panic. We haven't seen any of that. Really, what we're seeing is an insatiable desire to buy the dip. It still is here. It's alive and well. And who knows, this market may bounce for another couple of days or a couple of weeks. My guess is this is more like what we see early bear markets in other times in history, where you see these wild euphoric swings only to be, tested later on.
Great. Yeah. And I think it's really important to underscore here that sort of the whole reason why I wanted to bring this up was if our panel of esteemed roundtable experts there is correct, and we have further to fall ahead, that may be the right positioning for the long term, but you've got to still be aware of the fact that A, nothing moves in a straight line in the markets, and B, a lot of the status quo is still alive and well. The buy the dip folks, they won the day today, right? So you got to be careful for that. Given all the volatility, folks, I just want to mention, if you don't follow me on Twitter, I'm pretty active during the days, but I was super active last night and this morning, kind of doing a lot of play-by-play, both of the action, but also, suggesting potential market outcomes for investors to keep in mind, as the action unfolded during the day. If you have, any interest in following that, the easiest way to do is just go to Twitter, follow me at Menlo Bear, and you don't have to wait for a new video to come out. You can basically see in real time what what I'm sharing myself, but also what I'm sharing from a lot of the experts that I'm in communication with throughout the day. All right. Well, Mike and John, I'll let either one of you guys pick up this football, but let's talk about the miners before we close here, because you woke up this morning, gold was, 1965, let's say, an ounce or whatever. You would have expected the miners to be screaming higher, even with the S&P down. Now they weren't. And maybe you could say, okay, well, that's just because they're trading more like stocks today than the metals. They seem to be schizophrenic that way. They usually tend to pick the worst. But then as the S&P reversed, right? And when green, the miners just went lower and lower and lower. So it's kind of like they traded like stocks in the morning when stocks were down, and then they flipped to trade like metals as the metals came on down. So what's going on with the miners? Mike, I see you nodding, so let's start with you.
Yeah, the miners acted like the worst of both worlds. You're right today. It's kind of disappointing. Let's not forget that the miners are still sharply up over the last few weeks. But I was looking at a chart of GDX, the ETF that, the largest ETF that holds major gold mining companies. It was trading at 36 or so pre-market. In the market opened at 9:30, and it literally dropped immediately $1, like within the first second. It was trading at 35. And then as the S&P gained steam throughout the day, it traded lower and lower and lower, and closed at around $34, down only 67 cents on the day. The closing figures kind of mask how wild that swing was. But I think the jury is still out on gold, which is broken out of this bullish triangle that we've talked about so many times. It was a wild swing and a little disappointing to see the reversal, but if you step back and look at a weekly chart of gold, it broke through 1860, 1880 or so. It broke through to the upside from that bullish triangle. And yeah, it overshot this morning on this news. But if you take out this candle, which I know you really can't do, but if you really step back and look, it's still a very bullish breakout. So we have to give it some time. Same thing with GDX, using that as a proxy for miners. It's sitting here at 34. We've really been consolidating at 34 to 35 for the last week or so. Yes, we did shoot to 36 for a second this morning or so, and in the pre-market, but it's probably just consolidating sideways here. And I don't think I'd get too excited about it yet. Yeah, I think that sometimes people get emotional and they project what happened today into tomorrow and the next day too quickly. I would suggest to step back sometimes, take a look at a weekly chart. And those weekly charts are very constructive for both miners and for gold.
All right, thanks. And yeah, you mentioned that we closed around 34 something today. People would be frustrated that it didn't hold its gains from the overnight, but it was trading at like 29 just like 2 weeks ago or something like that. So you got to keep it all in perspective, like you're saying. So John, anything else to add to that?
Yeah, I guess I'd like to weave it into what we oftentimes culminate these conversations with you, Adam, about kind of what your guest had to say in terms about where they see presently, good places to be allocated. And if it's okay with you, I'll pivot a little to that because I think a common thread among your guests, Stephanie, Lyn, and Danielle, at least, they were all very much bullish on gold. Gold specifically, but also resources and hard assets in general. So to Mike's point, this bizarre kind of round trip action today. And again, to the way I opened up the comments today, the comments of your guests were 48 hours ago before this actual invasion took place, and I think those comments are every bit as appropriate and accurate and well-intentioned or well-incited as they were 2 days ago or today after the invasion. So the invasion and today's market gymnastics, I think, don't change that calculus. And they all, for the bigger picture reasons, supported, suggested gold as being a very good place to be, with the monetary regimes being forced to change, credit, there's amazing credit excesses built into the system. When the Fed went out and basically grandfathered in triple B, basically, kind of the worst of the corporate debt that that's not in junk status. There's in effect a lot of investment grade credit out there that's really junk masquerading as investment grade. And typically when credit strains happen, and certainly a recession would do that. I think it was Stephanie that talked about very likely a profits recession at a time when most analysts are projecting 8% across the board earnings percent increases in the S&P, and in some sectors, consumer discretionary, I think she said 40% was the street consensus. the market's really not pricing in an earnings recession. And you start to think about what, lower earnings and pressures on profitability and debt service, with these companies that have loaded up on debt, that's where, gold can be a really, really important insurance policy hedge. So that's just one thing I wanted to call out in those comments to pick up on what Mike talked about with gold.
Well, I appreciate you doing that. And that's what I wanted, is I wanted that kind of grounding context, because we often talk on these programs about the emotional state that a lot of investors make decisions from. And on a day like today, where, it started where you're like, well, this is why I own gold, right? It's crisis prevention and gold's up like crazy. It's doing what I expected. And then it disappoints you. And then the miners do something completely different than what you think they're going to do. You get the potential for people to just sort of get disgusted and throw the baby out with the bathwater, because they're frustrated in the moment and not necessarily looking at the bigger picture. So thanks for that grounding there, John. All right, folks. Well, look, things are getting very interesting, and wherever they go from here, we'll be tracking it together on this program with John and Mike. I have said this at probably every video I've ever recorded on Wealthion, but it's particularly germane here. We highly recommend that, unless you are a very seasoned, experienced investor, that it's best to be navigating this increasingly turbulent and uncertain future, leveraging the expertise of a professional financial advisor who understands all the macro issues going on that our roundtable talked about and that John and I just described here. If you've got a good one, great, stick with them. They're literally worth their weight in gold. We've been talking a lot about gold, but those folks are priceless. If you don't have a good one, or you're looking for an additional informed opinion from another financial advisor of that high quality cut, feel free to schedule a free consultation with the financial advisors that Wealthion endorses. John and Mike and their firm are in that mix. It's doesn't cost you anything, totally free. There's no commitment, no expectation to work with these guys. It's truly no strings attached. It's just a public service where we want to help as many people as possible get help navigating this incredibly challenging time for investors. If you'd like to set one up, just stick around to the end of the video. It's coming up in just a couple of seconds, where we tell you how to do that. And it only takes a couple of seconds to do. If you've enjoyed this phenomenal roundtable discussion that we had and would like to see more of that roundtable and more high-level guest experts like that brought onto the program, please do me a favor and just take a second to support this channel by hitting the like button and then clicking on the subscribe button below, as well as that little bell icon right next to it. All right, John and Mike, whatever happens from here, we will be tracking it together on this channel. Thanks so much for joining me this week, and everybody else, thanks for watching.
Thanks once again, Adam. We'll certainly be plugged into the machinations of these markets, short and longer term, and we look forward to speaking with you about this again next week.
Thanks again, Adam. I'm sure we're going to have a lot more interesting things to talk about in the weeks and months ahead. So thanks again.
If you'd like to schedule a consultation with one of the financial advisors at New Harbor Financial, simply go to wealthion.com. These consultations are completely free, and there are no strings attached. The good folks at New Harbor will simply answer any questions you have about your investment goals or your portfolio and give you their best advice given their latest market outlook. They're willing to do this because they care about protecting people's wealth, and because Wealthion has connected them with so many thoughtful investors just like you over the past decade. We started doing this because so many people have approached us in frustration, looking for a solution because they're feeling out of alignment or downright ridiculed by the standard financial advisors who have been managing their money. You know the type. The kind that just pushes all of your money into the market, scoffs at the idea of owning gold, and when you bring up concerns about the market's sky-high valuations, they say, "Don't worry, the market will always take care of you." For many of the reasons discussed in today's video, we think this is one of the most challenging and treacherous times in history for investing. We strongly believe that today's investors are best served working in partnership with a conscientious professional financial advisor who understands the risks in play. Now, we're agnostic which professional advisor you work with, as long as they're good. If you're already working with one, that's fantastic. Stick with them. But if you don't, or are having trouble finding one you respect or trust, then consider talking to John and Mike and the team at New Harbor. Now, for those about to ask, yes, there's a business relationship between Wealthion and New Harbor, which we've put in place to make sure everything is handled according to SEC regulations. All the details on this are clearly provided on the Wealthion.com website. Also, it's important to note that New Harbor is able to work with U.S. citizens, green card holders, and those with existing assets in the USA. But for regulatory reasons, they aren't able to take on non-U.S. clients. All right, with all that said, if you'd like some insight and guidance on how to protect your wealth during this unprecedented time in the markets, go to Wealthion.com to schedule your free consultation with the good folks at New Harbor. Thanks for watching.